Well, thank you, Chairperson, and thank you, President Draghi. I'm delighted to hear what President Draghi said about the EFSF and ESM treatment, and I'm sure it won't be long before it's applied to the GDP debt ratio in Ireland, so that we're comparing apples with apples. But I want to ask a question about the abuse of unaccountable powers in two parts, if I may, Mr. President. After every profound announcement made by a European institution, whether it's the European Council, the European Central Bank, the Commission or the Parliament, we seem to have to come to the stage where we await their eventual dismissal by what have become known as the markets. Are European institutions simply too weak to counterbalance, let alone influence, the puppet masters of financial power that globalisation has spawned? Are we being manipulated by unacceptable powers? Is it time to strike back and to cause public inquiry into just who it is who holds the fate of nations in their hands? And I'd like to suggest, perhaps in parallel with the ongoing actions, that it's time to maybe appoint a retired judge of the European Court to inquire into these matters. We need transparency, openness. I don't want a market that's tied up. I want a market that's a really free market. Second part of my question is this. If you can't tell the banks what to do with liquidity funds, and I accept the difficulties as you set out, Mr. President, how long more will the European Central Bank tolerate shady, powerful financial powers who refuse to pass on to mortgage holders and others the benefits of European interest rate cuts? Will the ECB seek to make these financial institutions behave more ethically? Thank you, Chairperson.
I'll come to your second question. We can discuss the first question separately because I'm not sure I grasped some of the elements. I think Portugal has actually done very well. The Portuguese program is fully on track, as it's been certified by the Troika recently, and it's quite clear, and I agree with you, that we have social tensions, that we have very difficult economic situation in Portugal and in other countries. But, and we've discussed this on other occasions, what's the alternative? Do you think that to go back and loosen the program?
More time.
How do you think, I'm sorry to use this word, markets would take this, which would be considered a reversal? My sense is that we should persevere, and Ireland actually shows that it does pay to persevere, because Ireland was able to return to markets last week, and the spreads in Ireland are actually much lower today than certainly two other countries, at least, certainly one, but perhaps two other countries, which until about a month ago had much lower spreads. So I think in the end we will see some benefit. It's clear that the situation is very difficult, but the fiscal consolidation is unavoidable. And the structural reforms especially are unavoidable to restore competition. In fact, the current account deficit is going down. Progress is evident. That's why I'm very hesitant, and I should say reluctant, to say, no, we should slow down, we should go back, we should reconsider, because now we are start seeing the first signs of progress in many of these countries, especially, I would say, in Ireland and Portugal. Now, let me come now at this, the unacceptable powers of markets. See, in a sense, I have no idea whether markets are, certainly markets have their share of opaque actors, certainly. But the point of fact is that what we have seen in the last year and a half is basically lots of investors, especially from the rest of the world, who were seeing their trust in the euro being weakened by various actions of the same actors in the euro area. And they saw this, their trust being weakened by actions taken at the euro area level, taken at national level, and so on. So the sense is that as this is being corrected at the euro area level, at national level, the rest of the world will come back and invest again in the euro area. And there is one good sign in such a sober picture that I should point out, that of recent, what's called the overall market sentiment, which is a catchword really for describing the situation of several key spreads, has improved. And we have not seen in the last month any outflow from the euro area. We've seen flows within the euro area, but we haven't seen what we used to see until a few months ago, outflows out of the euro area. I think we should keep this in mind. You see, your last question is about pass-through. And in a sense, it's related to the question I was asked before about the LTRO effects in the real economy. And unfortunately, we see fortunately, we see that some countries this pass-through actually happens, and in other countries it doesn't. And so it's a combination of different factors. By the way, one of which I've forgotten to mention is that now we are at a juncture now when credit is led by demand. And we are now laying out in place all the conditions whereby as soon as whereby there will be a time in which demand will take into account the very low level of interest rates, nominal, and the negative level of real interest rates, and they will incorporate this in their business decision and households decision. So we shouldn't be too pessimistic. We still foresee a mild recovery of the euro area by year end. Thank you.
Just pursue the last question. Just very briefly. Within some countries, some banks are passing on the interest rate cuts, but other banks are not doing this. And yet these people all continue to get liquidity funds. There are smaller enterprises and there are mortgage holders struggling, and we should be using every pressure we can to stop them putting their hands in the pocket of people who cannot carry the burden.
Oh, I completely agree. We've done this, as I was saying before, expanding the collateral eligibility. We've done a first step to this. But we should not forget another thing. There are countries where national contractual arrangements will make very difficult to pass through the lower interest rates. Let me give you a specific example. In many countries, mortgage rates are indexed to variable rate. So the interest paid by the client to the bank is now at historical lows. On top of this, there is a certain amount of commissions and fees that banks apply to the client. In many countries, these fees and commissions are being regulated or even legislated in their size. So the overall amount is way less than what banks can actually get from a government bond of their own country. Result of this, mortgages have dropped dramatically in some countries and have basically stayed where they were in other countries. So we have to consider these various arrangements, but having said that, I completely agree with you. We should do everything we can to make sure that the money is being borrowed from the ECB actually reaches the real economy, SMEs.